The views expressed represent the opinion of Barber Financial Group and SEC-registered investment advisor. Information provided is for illustrative purposes only and does not constitute investment, tax, or legal advice. BFG does not accept any liability for the use of the information discussed. Consult with a qualified financial, legal, or tax professional prior to taking any action.
So yes, we do have opportunity sets with currencies and commodities that are going to benefit from rising inflation. In fact, we have a piece I showed in a meeting earlier today that shows how much better we do during an inflationary cycle than a non-inflationary cycle. Bonds, we know, don't like rising interest rates. They tend to not do as well in that environment. Equities can do okay in both environments. So I think of the two, in my opinion, there's quite a bit of risk in the bond market, and yet many people may not perceive that.
Starting your route to retirement.
Welcome to the Guided Retirement Show. I'm your host, Dean Barber. Today, my guest, John Hampton, Executive Director at an alternative investment manager that has been applying systematic models to trade on behalf of investors for over 50 years. John and I are going to be discussing investing in alternative asset classes. Yes, we're going to talk about stocks. Yes, we're going to talk about bonds. But we're also going to talk about currencies and commodities and how the individual investor has the ability to generate returns regardless of the direction of what those four major asset classes are doing. Please enjoy my conversation with John Hampton. Great to have you here, John.
Dean, it's always great to be with you. I've enjoyed the beautiful Kansas City weather, and I'm looking forward to our visit today.
Let's really talk about investing from the way that the typical individual investor out there thinks about investing, and what you're going to hear on the nightly news, or even when you turn on CNBC or Bloomberg or one of those. 90+% of the conversations when it comes to investing is either what's happening in the stock market or what's happening in the bond market, as if those were the only two areas that matter.
Dean, you're exactly right. I mean, what you'll hear is a lot of information about stocks and bonds. In fact, the group I just spoke with earlier today, I talked about the Wall Street Journal, the Money and Finance page has been printed for 130 plus years, and yet there's a lot of additional opportunities out there besides stocks and bonds. And so people that do what we do take advantage of opportunities in the commodities markets. They take advantage of opportunities in the currency markets. And then one of the things that makes what we do especially nice is we're bidirectional. So we can make money when things are going up or when they're going down if we're positioned correctly.
And there's a lot of, I think you'll say, John, there's a lot of managers out there today that will do what they'll call a long-short strategy, where they can be long in the market or they can be short in the market. You can actually go out and buy an ETF that will be short the U.S. Treasury. You can buy an ETF that will be long the U.S. Treasury. You can even buy leveraged ETFs that are double long the U.S. Treasury or double short the U.S. Treasury. You can buy ETFs that short the S&P 500 or double short or even triple short on most of the major indexes today. And you get some really, really wild swings. And if you get caught on the wrong side of those, it can be devastating. So I'm curious about how people should feel about a fund or an investment strategy that is, like you say, bidirectional. That how do they know whether or not you're going to get it right? I mean, you mentioned an algorithm, but what does that really mean?
Yeah, Dean, that's a great question. I really believe in having good financial professionals or good professionals in your life, period. You know, you go to a dentist, he makes a recommendation to you, you trust the dentist, you do what he says. Same thing with a doctor. Well, in your finances, I mean, people that are looking for professional advice, and then strategic partners like us to you, we've done this for a long time. It's not our first rodeo. So as you mentioned, you can make a lot of money or lose a lot of money, long or short, if you don't really know what you're doing. So it goes back to our roots in the 70s. We built these proprietary algorithms, which are nothing more than just mathematical equations that actually run our money. And what's really nice about that is we don't have key person risk, unlike a fund that might have a big manager like Bill Gross or Warren Buffett. What happens when something happens to one of them? In our case, our algorithms, which have been built by very smart professionals, Yale, Harvard, Stanford, and graduates, have actually put these things together, and they've been back tested. We've tested them with fake money before we actually apply real money to them to make sure that they do have the intended consequence. So we look at things like, relative strength, trend following, non-trend following models.
I think it almost goes counterintuitive to most people, John, to do something that is the inverse of a positive direction. So it's, you say, well, bidirectional. That means we can make money when things are going down, and we can also make money when things are going up. But in order to make money when things are going down, that means you have to bet against the market going up. And when we look at statistics tell us that most of the time the market goes up. And so, but you're not just talking about the market itself that you're bidirectional on. So I want you to explain more about kind of the four core components and the four major or core markets, I guess it is, where you're bidirectional.
Dean, it's a great question. I think a lot of people, when they speak of market, they think of the S&P or the Dow, and their mood for that day kind of depends on whether their phone shows green or red. But what we do is, and what people that do what we do, they do a lot more than that. So those four broad core categories that people like us trade would be equity indexes for sure, interest rates, or what a layperson would call a bond. But two of the other buckets that are very large and have great opportunities, particularly now, are commodities and currencies. So we've seen a lot in the news today about energy prices soaring, and it's costing you substantially more to fill your pickup truck or your car up. Or you go into the grocery store and you buy a loaf of bread or cereal, and we see grain markets that are expanding. We have the opportunity, if positioned correctly, to make money when those items rise or fall.
And I think that's important. And I think that when people say, okay, investing in futures or in commodities or in currencies, that's foreign to most people. That's not, I think most people think, well, okay, what am I doing here? This is gambling? Am I taking a lot of risk? What is it?
Yeah. Dean, if you did it on your own, it can be extremely risky. Back to hiring a good professional. If you do this with someone that's had 50 years of experience, has a lot of people that have done this for a number of years, it's not so scary. In fact, if you look at the risk profile, not any riskier in many cases than some of the equity indexes that they may already be in. So it all boils down to experience. You want to make sure you're dealing with someone that's done this for a long time.
Let's go back to this idea of the interest rate environment. I want to go to the bond market. I want to talk a little bit about the bond market because we're in an environment, as you and I talk here today, where we're seeing the real threat of inflation being around for a period of time is very, very real. We're coming off of a time when we've had a zero interest rate environment for a long period of time. I think our 10-year treasuries bottomed out around 1% or so on the 10-year treasury, and the 10-year treasury's on the rise. The Fed's raising interest rates, and right now that's not very good for bonds. And if we back up, John, back into the early 80s, that was the last time we really experienced any significant inflation because Volcker jacked the interest rates up. And I think there was one point where a 30-year mortgage would have been above 17% for a short period of time, and that actually killed inflation altogether. The 10-year treasuries, the 30-year treasuries, they had huge yields on them, and those yields have been declining now on those types of investments for 40 years. But it's changing now. So what was something that was simple, I'm going to put my money in fixed income, interest rates are going to go down, I'm going to get that higher yield from before, my bond can actually go up in value so I can get appreciation and I can get a nice yield. You can't do that anymore. And the 60-40 portfolio of just having some money in the S&P 500 and having some money in the bond ag, well, where we sit here in 2022, that's not really what a person's looking for.
It's going to be very difficult, Dean. In fact, Mark Twain was famously quoted as, history doesn't repeat itself, but it does rhyme. And so what's interesting is I'm talking to my 34-year-old son who's never really experienced a period of inflation. And now we're seeing what happened back in the 70s and 80s begin to rear its head again. And it's going to create a difficult environment, particularly for folks that got so fond of bonds and really had a 40-year bull run where bonds could do no wrong.
Right.
They really, really did well there in that environment. But we know the relationship between bonds and interest rates, and the years ahead could be difficult.
So, John, how are you looking at this inflationary time frame?
Commodity prices are up, interest rates are going up, inflation's going up. I think, most people think, well, gosh, if we have high inflation, we get an economy that stagnates. We run into the period that we saw between 1972 and 1980, where the total return in the stock market over that 9-year period was about 17% over 9 years.
Right.
So less than 2% a year. And bonds during that period didn't make any money either. And so it was kind of a lost decade for both stocks and bonds. And so the traditional investor is grappling today with, how is it possible to make money in those timeframes? And I think what you're going to say is you got to look outside of the traditional asset allocation.
Dean, I couldn't say it better. And I also would say that hiring a professional really is what people need to do. And having a financial advisor looking out for your interest and coming up with unique, sometimes out of the box ideas that can create a good return, but maybe in a non-traditional way. So yes, we do have opportunity sets with currencies and commodities that are going to benefit from rising inflation. In fact, we have a piece I showed in a meeting earlier today that shows how much better we do during an inflationary cycle than a non-inflationary cycle. Bonds, we know, don't like rising interest rates. They tend to not do as well in that environment. Equities can do okay in both environments. So I think of the two, in my opinion, there's quite a bit of risk in the bond market, and yet many people may not perceive that.
One of the biggest equity managers in the country, AllianceBernstein, I had a representative from AllianceBernstein on. I think this would have been late 2021, sometime in the fourth quarter. And the AllianceBernstein has done the work, and what they had put out were not really very favorable projections. They were saying that from that point, that if you look forward 10 years, their projected average annual return for the stock market over the next decade was around 5%, and their projected average annual rate of return for fixed income over the next decade was 2% or less. And so if you got a 60-40 portfolio, now you're down in the 3% range, maybe 3.5% range on average for the next decade. And yet you've got people heading into retirement, and they've been told that 4% is a safe withdrawal rate. And now we're in an environment where, okay, how am I going to get that 4%? So that's where you get kind of out of the box thinking comes in, because it's not the traditional 60-40 portfolio that would have gotten you there over the last 10 years. That's not what's going to get you where you need to be in the next 10 years.
Dean, that's exactly right. And I think some of us have gotten lulled into this 60-40, set it and forget it, put 60 in equities, 40 in bonds, and the world's going to turn out right. And that actually did well over the last couple of decades. But where we're at now, we're going to have to think differently. And investments that came through and produced for us, may not. That's back to change. There's always change. You have to be prepared for change.
I'm grinning here because we did another video. I think it was part of an educational series that we had done. And we were pointing out that if you go back to the dot-com bubble, 2000, 2001, and 2002, where in that 3-year period, the stock market collectively lost over 40% on the S&P 500, and the NASDAQ was down over 70% over that same period of time. But if you looked at what treasuries did or the bond market did in those 3 years, the bond market actually had double-digit returns. So in that market fallout, if you had the 60-40 portfolio, those bonds really buoyed you up and prevented the huge losses that the people that were all stocks experienced, and it worked. And yet what we're seeing right now is a rising interest rate environment, which is bad for bonds, an inflationary period, which is bad for bonds, and an overvalued stock market that is as volatile as anything, and it's not working right now. And I think I don't see how mathematically a person can say that bonds can do well, just, again, your traditional bonds. And there are bonds that are going to do really, really well in the next decade, but they're not your 10-year treasuries, they're not your 30-year treasuries, they're not your high-quality corporates. They're different types of bonds that people are going to have to go after. But they don't even know where to go to look.
Exactly. You know, Dean, I think there's always opportunities to make money. You just have to be open to looking at new ideas and new ways to run your money. And just because something worked for 10, 15, 20 years doesn't mean that we shouldn't take a fresh look at things, particularly when we see the geopolitical environment that we have. I mean, back to, we talked about commodities earlier. There's just some real opportunities out there with energy prices going through the roof. We have the ability to benefit from that. But it's more than that. You look at some of the metals that are being traded, like nickel that's being used in batteries. We hear a lot of talk about electric vehicles and batteries, and copper that's used for building materials for homes. Or in the case of ag, grains, this unfortunate crisis in Ukraine and Russia, we've seen that being one of the breadbaskets where a lot of grains are grown. And we're right here in Kansas where a lot of grains are grown. There's opportunities to make money in ag as well. So these are all things that are opportunity sets that may not have had the opportunity, in previous years like we have now.
So talk a little bit about how you view, John, the different currencies. We haven't really talked much about currencies yet, but commodities, your stocks or bonds that you can be bidirectional, and you can really be bidirectional on all of these. When you're doing that, is there a mix? Is it 25% in each one of those? Is that how you like to say you have your diversification, or are there times when you'll be overweight or underweight in one of those areas?
Yeah, I like to tell people we're not equal, 25, 25, 25, 25, but we're fairly balanced, and we want to stick to our knitting and make sure that our standard deviation stays within a certain range. We have a really low correlation with stocks and bonds, so we don't want to begin to morph, 90% equities if equities are going up and look so much like an equity. So we try to stay disciplined in each of those four buckets, and it could flex to 30, 32% in a bucket, but we're never going to go 90% in one bucket and 10 in the others.
So it would be fair to say that a goal of your strategy then is to not look like the stock market. It's to be something that's an alternative. Could be a potential hedge if markets are falling apart, could be a potential hedge if interest rates are rising, could be a potential hedge if we got high inflationary periods. When could it be a drag? When could it be like an anchor that's stuck on the bottom of the lake and you got to wind up cutting the line to get away?
An environment where we have extremely low interest rates and extremely low volatility is a period that we don't do as well. People that do what we do don't do as well because we need some direction. We need to know whether bonds are going up or down. We're agnostic. We really don't care if bonds go up or down. We don't care if gold goes up or down. We just want to know which direction it's going to go.
So there's got to be movement.
There's got to be movement. We've got to see relative strength. We've got to see a trend emerge. And if we see a trend emerge, we can make a lot of money in that environment. Where we have to be careful is where the trend reverses and goes the other direction. If we can catch that quick enough, we can cut the damage that could be done if we stayed in the trend too long. But there's a lot of opportunities. It's just finding direction. And in a market where there's not a lot of vol, if you came off of the period of 2008, the great financial crisis, we saw Feds take their rates to zero. We saw artificially low interest rates. We saw artificially low VIX, so the volatility rating was very low. That was a harder environment for us. That's not the situation we're in today, Dean. There's lots of volatility. We have all kinds of geopolitical events that are taking place and a lot of unknowns. And as you know, Dean, the markets don't like unknowns.
No, the markets hate uncertainty for sure. And of course, as we're talking here today, there are several things that are very uncertain, and depends on when people are listening to us here, John. They could be picking this up a year or two after we did it. But I want to say that this reminds me a lot of 2008, of all the uncertainty that's out there today. And if it reminds me of it, it's got to remind a lot of our listeners or viewers, well, it may not be unfamiliar, it's still uncomfortable.
Yes.
And you're talking about going one way or another, shorting bonds or being long bonds, or shorting the commodity prices or being long on commodity prices. I think the difficult thing for people to understand is that it can work, but it's not black and white. It's not just I'm going to go pick an index fund and that's going to be my answer.
Yeah, it's the devil's in the details, Dean. It's very complicated. That's why we have some of the brightest minds working for us and build these algorithms that can spot these trends and these trend reversals when need be. So this is not a do-it-yourself, deal. You really need a professional working with you to help you get it done correctly.
Is there a handful of companies out there that are trading the commodities and the currencies and bonds and stocks and can be bidirectional in all of those areas?
There are a number. When we started back in '72, we were one of the pioneers in the space, and there were a couple of others that came along. Since then, that set's gotten very large. There's probably hundreds of companies that do that, each with their own flavor, each with their own bias towards a different style that they tend to favor. All good companies, they just do it differently, and that's part of your advisor's due diligence process, is to make sure they find the right one.
So, what do you consider to be your strategy? What would you call it? Would you call it an alternative strategy? Would it fall in that alternative space? Would it be a long-short strategy?
Yeah, in years past, Dean, people would call us trend followers, which sounds pretty simple. You find a trend, you find gold going up or going down, you pile into that trend and you make a lot of money. That was kind of the old school name for us. We're what now the modern nomenclature would be systematic trading. Or rules-based trading, where we try to take the emotion and the greed out of the decision. We have these algorithms that really are very efficient, and they can manage volumes of money, as opposed to a human being who's fallible, who could make a wrong call on whether gold's going to go up or down. We try to take the greed and the fear out of the marketplace.
Those are the two strongest human emotions out there and the most dangerous when it comes to investing. So
yes,
the algorithms taking that out is a big deal.
Yes, it is. And also the key person risk. When you build a firm, if you build your firm, let's say Berkshire Hathaway, Warren Buffett, a name that's so recognized, but I think there is a lot of question about when something happens to Warren Buffett, who will fill those shoes? When something happens to a Bill Gross, who will step into those shoes? And so we don't have that risk. We eliminate that key person risk. So our assets don't get on the elevator and go down and out of the building every single day. So,
John, talk a little bit about the risk of loss, and I think one of the biggest things that people get scared of when they start seeing any asset class decline, whether it's bonds going down because interest rates are going up, whether it's commodities prices. They don't get so concerned about commodities prices falling because that makes things more affordable for them, but they do get concerned if they own commodities and the commodities prices falling. They get concerned if stock prices are falling. People probably don't understand how currency exchanges work, so they don't really play in that world too much, but there are some funds out there that specialize in that, and I know that's a part of your strategy. I think what I'm trying to get at here is there are a lot of people, if they don't clearly know how far can this thing fall, right, before it actually stops falling and turns around, they think that, oh my gosh, I'm going to lose everything.
Right.
How do you guys think about loss in terms of that? And what do you do to help mitigate that?
Yeah, I think, one of the things we do is we set some risk parameters around what we do and how much, I'll use the term standard deviation, we're allowed in each of those four broad buckets. We try to make sure that we don't get out too far out on a limb. And if we see these algorithms begin to start chasing equities and get too heavy into equities, we can pull that back. And we typically let the algorithms run, but there's times when we won't let it exceed a certain, target threshold. And when speaking of risk, we mentioned currencies, and there's a lot in the news about Ukraine and Russia and the Russian ruble, and that is a currency we did trade that we're currently not trading. So our job is to dig down into those portfolios and make sure there's nothing in there that's going to blow someone up. We want to really be careful that as things change in the news, that we're monitoring that to make sure we don't create an outsized loss for a client.
So when you think about risk, I think about it differently, and I think about it from a financial advisor's standpoint. And most of the people that I work with are approaching retirement within the next 5 years or so, or are already retired. And so risk to me is not volatility. It's not price fluctuation up and down, plus or minus 10 or 20%. To me, that's not the risk. The real risk that I think people at that time of their life face is the risk of running out of money or the risk of not being able to live the lifestyle that they want after the paychecks stop coming in. And so I make that point because I think that sometimes you may look at managing money like what you guys do in some alternative asset classes, systematic trading, and it doesn't fit the norm, but it can actually reduce volatility in an overall portfolio. And if it can reduce volatility, and in some cases it can enhance performance, then all of a sudden we don't want to look at what's the risk of the strategy that you're managing versus the risk of the stock market or the risk of the bond market. What we're going to want to look at is, can the addition of these types of strategies reduce the risk of running out of money because we can get more consistent returns with lower volatility? To me, that's what I think about risk.
Dean, that's exactly right. There's an old saying, the whole is greater than the sum of its parts. So what you're saying is, as we take a 60-40, let's say, for instance, stock and bond portfolio, and we introduce maybe 2 or 3 different alternatives, whether it's systematic trading or real estate or credit or whatever it might be, you might find that when you roll up that total risk for that portfolio, as you say, it may go down and the return actually may go up. And that's what we're really striving for. And that's what's great about working with somebody like you and your firm, is that's your job, is to put the right recipe of investments together to create the greatest return with the least amount of risk. And you referenced the 4% withdrawal rule. There was an article this week about how that rule's dead. I mean,
that's now, what is it, the 3.56% withdrawal rule or something crazy like that? Yeah.
Exactly. And I referenced in the meeting we were in earlier, I had an old timer at a meeting come up to me and he goes, man, back in the 70s, you could get a CD that was 17%. I wish we had those days again. And my response is, not really. Because when you have a 17% CD, everything you buy, everything you finance is at a higher rate. So we want rates at a reasonable rate, but not at a hyper high, rate. So that's important to realize.
I think the one takeaway here for everybody that's an investor is look beyond just the traditional stocks and bonds. And if you don't have the expertise or the time to dig in and do this on your own, get some help. Get some help and get educated. And if you work with the right financial planner, they're going to educate you along the way. And the one thing I know, John, is this is year 35 for me in this industry. And so there's almost nothing I haven't seen. And it's not static. You don't apply a single strategy and just assume that it's going to take you through the rest of your life. You have to be willing to make changes. They're not all huge changes, but you have to be willing to make changes along the way to wherever the prevailing wind is blowing, so that you can reduce risk as much as possible and try to get the best return possible relative to the risk you're taking.
Dean, you're exactly right. That's one of the things I really enjoy about our relationship. We both like to read and educate ourselves and learn, and we have to be open to new ideas. And the people that are sitting in the 60-40 standard portfolio, and it's the fear is, or the concern would be that that's done so well, I'm not going to change anything. Let's don't rock the boat. Let's just leave things like they are. And yet, when things change, we have to tweak around the edges, or in some cases, we may have to make some more drastic changes to the way we do things.
You know what that reminds me of?
Yeah.
Cruising along the Interstate 70 out here in Kansas, it's flat, it's quiet, it's all, you got the cruise control set on 75. That's the speed limit. You could set it on 80. Some people get a little bit more aggressive. Right. And then all of a sudden you roll into a massive thunderstorm with 30-mile-an-hour winds, and you never turn off the cruise control, right? The risk is present there. You can see it. Who would not slow down and start to take caution? And what I'm saying right now is the risk is present. We can see it.
It's
so
there.
It's time to slow down and use caution.
Absolutely. Yeah, you have to look at what's coming. And I think Wayne Gretzky said, look, skate to where the puck's going, not where it's been. And we see these dangers in front of us. It's only the wise person that would make changes and adjust to that. And there are black swan events, we call them in the financial world, things we couldn't have expected, like 9/11. COVID-19. Who would have thought that we would have been locked in our homes for so long and not be able to get out? And yet, we have to have a presence of mind and a financial team to help guide us through those. And it may mean some adjustments to our portfolios to make sure we succeed.
Almost always does.
Yeah, exactly.
Unless you're just going to bury your head in the sand and just kind of do what I call the buy, hold, and hope strategy.
Exactly. Yeah. Hope is not a good strategy.
No, it's not. Well, listen, John, thank you so much for being here. John Hampton, we've known each other for a long time. It's great to have you as a part of our program here, and I hope you enjoy the rest of your day.
Dean, thank you so much. It's been a real pleasure. I've enjoyed every minute of it. Thank you.
Absolutely. I hope you enjoyed my conversation with John Hampton. As always, you can check out a link in the show notes where you can schedule a 20-minute Ask Anything session with one of our certified financial planner professionals, where you get an opportunity to ask them anything that might have come up during my discussion with John Hampton. Look forward to talking to you. If you're watching us on YouTube, make sure and subscribe and share it with your friends. Give us a thumbs up.
Starting your route to retirement.